Everyone talks about taxes and market crashes, but there's a bigger risk to your retirement, and it hides late into your retirement years. And today, it's draining families at a whopping rate of over $12,000 a month. Today, I expose the hidden truths behind long-term care and what you and your family can do today to protect your money and your loved ones. Check it out. So understanding the long-term care risk. This is, first and foremost, it's a risk. All right. This is not about long-term care insurance. This is about the risk of needing long-term care. And the big point that I want to make here is that there is a funding gap. Okay. I think a lot of times people think that this stuff is covered by insurance, and I'm not worried about it because I have health insurance. So we're going to talk today about what this risk really is, how it presents itself, the impact it has on the family and the retiree, and then some strategies. How's the world adapting to this risk? Your money is at war. Okay, there's a lot of factors out there competing for your dollars, confiscating your money. This is a big one. So let's talk. What is long-term care? Long-term care is care or assistance that is needed typically due to old age or frailty. And it's just a fact of life. It's getting old. It's not being able to do the things you used to be able to do, but specifically, there are activities of daily living. And these are buzzwords in the industry. They're things that you should be aware of as you plan for this stuff. So these activities of daily living, bathing, dressing, transferring, that means getting in and out of vehicles, getting your body physically around, continence, I think we know what that is, meal prep, feeding yourself. Okay, these are all called activities of daily living. If you need assistance as deemed by a physician under an approved medical plan, if you need assistance with 2 of those 6, then you are in the sweet spot for long-term care and triggering benefits of associated plans. The other end of this is cognitive impairment. So things like Parkinson's disease, Alzheimer's disease, dementia. Okay, so it's either you have the inability to perform these activities of daily living just due to old age and frailty, or you have a severe cognitive impairment. Okay, those are the triggers. Those are the descriptions of what we're talking about here. But when you actually talk about the care itself, what kind of care is available out there? There's different ways to describe it, and there's different levels of care. So I break it down between informal care settings and formal care settings. So on the informal side, we've got things like home health care, which is usually everybody's favorite. You know, in general, we want to age in place as much as possible. People do not like to move out of their forever home, especially late in life. So home health care is a very popular one. Adult daycare, somewhere for mom or dad to go during the day while caregivers are working so that they're taken care of. Assisted living, more of a permanent solution, involves changing where you live into places where there is on-staff assistance with some of this type of care, and that's usually the day-to-day stuff. Getting dressed, making your meals, taking your medication, stuff that can be done by a non-licensed professional. Custodial care. These are the informal levels. But then when you get to the formal level, where there's a licensed care facility, and we typically think of these as nursing homes. That's more of a formal thing, and that's typically under the care plan of a supervising physician. So, if you're on this call, hopefully this is something that is at least somewhere on your mind. So as you get ready to plan for retirement, and we're talking about bucket list items and enjoying the good life and all of that, we got to understand there are 3 phases to retirement. And those phases are the go-go years, the slow-go years, and the no-go years, right? So those go-go years are the ones that everybody's usually most interested in. That's the portfolio conversation, the retirement income, and how we plan for living in retirement, pension planning, all that good stuff. Those slow-go years are the warning years. That's when your body's not able to do all the things that you have on your bucket list. Those no-go years is what we're talking about here. And this can be a very, very critical stage in the plan, because really, in order to have a successful retirement, you got to master all three of these phases. It's disastrous to not have some plan in place for this type of care. Not only financially is one thing, and that's usually what we're here to talk about, but I'm going to spend a little bit of time today talking non-financial, because I think that's really what it takes to inspire people to take the action. So the reality of this thing, and statistics are an uncomfortable thing, but if you're a married couple and you find yourselves both alive at 65, the studies are showing there's a 70% chance that somebody's going to need some form of care at some point. So we all like to think it's not going to happen to us, but God forbid. If it did, how does it impact us? So just some background. When does this stuff typically hit? Well, the stats show that this is mainly a problem for females. They tend to live longer than us guys. And, we're getting really good at fixing the body. We're not getting so great at fixing the mind. And a lot of problems are showing up in trends that we'll discuss. But in general, the vast majority of these claims that we see out there are female. And the age, well, you can see here, youngest is 38, the oldest claim is 103, the average is 84. The reality is, and I always tell this to people, we don't get the benefit of living on average. Average is a fun coffee table conversation. It's fun for statistics. But you don't get to live on averages. You get to live on actuals. And 70% of people means that there's a really high likelihood someone on this call is going to need some form of care. Here are some of the issues. Here's what we see, and these are from insurance companies and the industry. What are the reasons that we see people going on claim? And the big far ahead winner is the nervous system. It's Alzheimer's. It's dementia. So these cognitive issues are outpacing the physical, the old age and the frailty. There's a whole lot of buzz out there on what's causing all of the Alzheimer's, what's causing all of the dementia. This stuff didn't exist a couple generations ago. So it's in the water, it's in something, it's in the food, but we're doing things that are causing this to become a bigger and bigger issue. So the generation that's on the phone today planning their retirement will see most likely a very large increase in these numbers. The physical issues, it's the old age and frailty. So musculoskeletal is the big one there. Cerebrovascular, strokes, accident injury is actually pretty small. I think that's where most people tend to think it comes from, and it's actually one of the very smallest. Illness related, again, smaller, but the big one here is the blend of cognitive downfalls, dementia, Alzheimer's. Parkinson's isn't on this particular list, but it's another big one. So these are the big reasons that we're seeing these things happen. And here's some just general information. If you do go on claim, this is the statistics, as I said, the averages, but just as a point of reference, men have about a 2.5 year length of claim. Women have a little bit longer, about 3.7. The big one to understand is the Alzheimer's, the dementia cases. These can be very, very long claims. And since this is an expensive problem, the longer the claim, the bigger the problem. So what are we seeing out there? Well, we're seeing a much higher demand than previous generations for some of the things that we've already talked about. But there's other trends that are contributing to this. Longer lifespans. Like I said, we're getting really good at medical interventions and making people last longer, but we're not really getting good at fixing the brain and the mind. So that's causing problems. The government, well, the government is broke, ladies and gentlemen. They are deeply in debt, and I think a lot of us think we can lay back and relax and hope that it all gets handled. But as I said, this is not a risk, and these are not expenses that are generally covered by health insurance or Medicare. This is a funding gap. You're not sick in these cases. You're physically okay. You just simply can't do the activities of daily living, or your cognitive ability is destroyed. So these are big problems, and the geographic dispersion is another one. It's not on this chart, but it's worth talking about. It used to be people, big families all lived within a certain geographic area, and it was usually pretty a tight area down to neighborhoods. But the trend has been geographic dispersion. So we see families spread out all over the United States, sometimes even into other countries. And when it comes down to someone needing care, very often family is not as available as it once was. So if you're on the call, God bless you. I hope you never need care. But if you did, if you're one of those 70%, let's talk a little bit about how it impacts the family. All right, because we think about it in terms of ourselves. We're thinking usually financial planning, money planning, retirement planning, just hard dollars and cents. This is a bigger issue than that. The family impact is massive, and I could spend this entire time talking about this particular issue. So if somebody needs care, and I hear this a lot, my children will take care of me. My daughter will take care of me. My sister, we've got an agreement. I hear all kinds of different thought patterns on how this is going to be addressed, but I don't know that we always give thought into how that situation manifests in a family. So your spouse, it's one thing to enjoy retirement together, but if you find yourself being the primary caregiver of your spouse, let me tell you from experience and observation, it changes the dynamic of the relationship, and it does so dramatically. To be the person that is on the hook for primary medical care for your spouse has a very dramatic impact on the relationship. Physical challenges associated with the basic stuff, getting in and out of the bathroom, getting in and out of the shower, caregiving children. Please give thought to this one. And it, some of this can be hard to hear, but I want to be real with everybody. If your children are on the hook, or if that's your plan, I need you to visualize. Is it your son-in-law or your daughter that picks you up off the toilet or takes you out of the shower? It's that serious. It's that real. And what is the impact that it has on your children? And here's the biggest impact across the board from what we've seen on this. It's the caregiving daughters that suffer the most. For whatever reason, it's naturally assumed that the daughter will be the primary caregiver. And obviously the maternal instinct, there's reasons for that. But now factor in the daughter, because if the parent is requiring care, they're in their 70s or 80s, that puts the daughter squarely in the retirement red zone, where they're worried about their own retirement. Now they find themselves maybe financially and definitely time allocated to caring for their parent. And that causes a lot of stress and strain on the daughter's marriage. There's a lot that can be said there. I don't need to go any deeper, but siblings, right? If it's not just the daughter, what if the daughter lives remote and the son lives local? Now we've got issues with adult siblings who may or may not agree with how mom or dad needs to be taken care of. And that can cause massive stress and strain in the sibling relationship. And, is somebody, maybe one of the kids doesn't work. So they're the natural person to choose for caregiving, whether or not they're the best caregiver. So the dynamics of the family get massively impacted here. And if you don't have children, if you're single, who is going to be the caregiver, right? If we want to age in place and we want to stay at home as long as possible, who is the caregiver? There are many, many factors that come into this, and not the least of which is financial, but I would say that the family dynamic is more important. So when you're planning out your life story and the dream of a good retirement, not having planned, not having prepared, not having funded the long-term care risk can cause a very disastrous end to the plan. And I've seen families tear themselves apart over a lampshade or who gets grandma's necklace. And it's disastrous. And planning ahead can make all the difference in the world. This stuff is not cheap, right? So just some national numbers. Informal home care, $77,000. Assisted living can run as high as $65,000 a year. Nursing homes in Michigan, we're in the $10,000 to $12,000 a year range for nursing home care. And understanding that, yeah, I understand Medicaid can be a fallback position, right? If all else fails, Medicaid will cover some of these costs. But I promise you, if you can avoid it, being cared for in a state-run Medicaid facility is not the ideal, right? So we want to do anything and everything that we can to make sure that this is planned for, because this comes down to dignity. I think that's the best word I have found to really encapsulate this whole thing. It's dignity. If I'm the aging adult that needs the care, if I have relied on my children for that care, I have to watch the dynamics play out in their world. And if I haven't provided funding for it, and if I haven't provided provisions for it, what is that impact going to have on me emotionally as I'm leaving this world, watching the damage I've left behind? That's why this one is so big. It's near and dear to me. I mean, we talk a lot on this call about the retirement income challenge and really nailing down the retirement income problem. Well, once the income problem and the sufficiency and efficiency of retirement income is nailed down, this is the next priority. So if you ever did need care, how would you pay for it? And here's what I would say about that, just aside from the YouTube guy at the beginning, because again, not a plug for long-term care insurance. Everybody needs a long-term care plan. Some people need long-term care insurance. Okay, so whether or not you're thinking about insurance as a solution to this, everybody needs a plan. You need to have a plan for how you want to be cared for, how you want your spouse cared for, and that needs to be a part of your overall financial plan. But when we talk about money and how we pay for this, the traditional methods, there are some taxpayer assistance programs out there. Medicare generally will only cover certain things like durable medical equipment or specific things related to hospital stays. And those are temporary, they're short term. This is not the end all be all. And Medicaid, if we think that you're going to fall back on Medicaid, please understand, you have to be, for all intents and purposes, broke for Medicaid to step in and pay for this. And there's a whole field of planning out there for Medicaid planning that is designed to spend down, hide, shield assets so that you qualify for Medicaid. Again, there's financial approaches to that, but I promise you, the care setting in a Medicaid facility is not what you're hoping for. So if we're in planning mode and we're talking about strategy, we want to avoid the Medicaid route. They do have traditional long-term care insurance, and that's where this is a big expensive risk. And anytime there's a big expensive risk, one of the things we look for is the ability to transfer that risk to an insurance company, and the trade-off there is the premium that we send in to pay the risk. There's a whole lot of reason why people aren't buying this stuff. It came out and it was very popular, but the insurance companies didn't have a lot of background history to understand the claims experience that they were going to go through. So it came out initially pretty inexpensive and a lot of people bought it. But then over time, when the claims started coming in and the costs started coming in, the insurance companies got hammered and they went to the insurance commissioners and they made a case for raising rates. Now in traditional long-term care insurance, they can't raise your rates as an individual, but they can raise your rates as a class. So as a 75-year-old male or a 60-year-old female, they can and do raise those rates. So the problems that have been really experienced in the traditional long-term care insurance world is, number one, it's on a health insurance chassis. And what I mean by that is, think of the health insurance model. You don't own anything. You send in premium dollars, and if there's a claim, they pay it. But if there's no claim,
then those dollars that you sent to the insurance company for 20 and 30 years are just lost. And when you lose those premium dollars, think like an economist here. You didn't just lose the premium dollars. You lost what those premium dollars could have done in your personal economy over those 20 and 30 years and beyond. It's a big loss. Those are called opportunity loss. And very few people pay attention to those or ever even calculate them or focus on them, but they are the big costs. So it's that loss of premium for no benefit that causes a lot of people to run. But the other big thing is that the insurance company's response to these large claims is to jack premiums. So if you get into traditional long-term care insurance in your 40s and 50s because you're being very responsible about it, those premiums are probably manageable. By the time you get around to needing that in your 70s and 80s, the premiums have been increased substantially. And they price most people out of the game. And that's probably the worst of all worlds. To pay premiums for 20, 30 years and then get priced out of the game and let the insurance lapse, and then you have your problem. That's the worst case scenario. So some people are paying out of pocket. I'd like to hear that term out there that people use, self-insured. I've got enough money that I'm self-insured. Well, if people could self-insure efficiently, the insurance business would be nowhere near what it is today. You can't self-insure because you don't have the tax code and you don't have the law on your side. So if you're paying out of pocket, you're doing so very inefficiently. And if you're doing so from retirement assets, that risk may hit you at a time where the market's not favorable. So not only do you have to sell a retirement asset in potentially a down market, you still have the tax hit before you take what's left over and use that to pay for the long-term care needs. So it's a very inefficient way of handling the risk. So, the impact on retirement, this becomes an income problem. It's a cash flow problem. It's not an asset problem. So, if you do need this type of care, it becomes a new bill, with no end date in mind. This stuff doesn't get better over time. It gets worse. So what you see is when these bills start hitting, people start foregoing other items of cash flow, and things start getting let go. Maybe it's the travel, maybe it's the higher end eating out. So all of these things start to gradually take away, and eventually it becomes the critical items are no longer being paid for. And that becomes a problem that is the reason we're on this call today. And assets, how people have traditionally done this, it creates ripple effects throughout the economy of not only the person who needs the care, but the generations below them. It can be pretty devastating. So how do we get efficient about this? Well, the government has made some moves that you should be aware of that have at least gone in our favor. They don't always go in our favor. So when they do, we want to be sure we're aware of them, spread the good word, and make sure we're taking advantage of them. So in 96, the HIPAA law gave us the ability to pay for qualifying long-term care expenses tax-free. So that's a big bonus. Now, how that plays in and how we get to the funding miracle is coming up shortly. The Pension Protection Act. So a lot of people may hold annuities in their portfolio. The older annuities prior to 06 were not Pension Protection Act compliant, meaning they didn't get this favorable tax treatment. You still had to pay ordinary income tax on the withdrawal from the annuity prior to paying for care. Well, that's been alleviated by some of these different acts. So that starts the conversation. And there are new strategies out there that you should be aware of to help finance this risk. Now, there's a window that I would say, if you don't have sufficiency of retirement income, if we don't have that risk nailed down first, this may or may not be a thing. The window is when you have assets to protect. It's when you have income needs, a higher lifestyle that you're trying to create and maintain. That's when the risk comes in. Because if you don't have the assets or the cash flow, the long-term care risk is going to eat up assets and income very quickly, and we'll be on the Medicaid conversation. This is for the folks that are trying to maintain the middle income, upper middle class standard of living through retirement and beyond. This is a huge risk. So what we're doing nowadays is using asset-based care solutions that use existing assets or newly created assets under the Pension Protection Act and the HIPAA rules to basically carve out a portion of your existing portfolio of assets. And we'll talk, there's a few different ways to do this, but the concept is you use your assets very tax efficiently to cover the risks early on. And then through the newer benefits that are available out there, the insurance company's money, and this isn't traditional long-term care insurance, but these newer asset-based solutions, they are able to pay for the long-term care claim needs as much as up to lifetime of either one or both spouses, and on a tax-free basis. That's the part I can't emphasize enough, right? Because if we don't do this correctly, there's no provision in there that says you can use your IRA or you can use an old annuity and get these benefits. We have to plan ahead for the type of assets that we own in order to take advantage of these. So I'll give you a couple different examples, and then I'll talk through each, and then we'll see what kind of questions we have out there. But I had mentioned before that traditional long-term care insurance rides on a health insurance chassis, and that's the premium pay model. So you pay in, it's like leasing. You pay in, and if you don't have a claim, you don't get a benefit, and the money is gone, kind of like leasing. Well, these are asset-based. This is more like owning the benefit, where your assets form the initial basis of a benefit plan to pay for care. And that can either be on a life insurance chassis, or that can be on an annuity chassis. And the factors for which are many. We don't have to get into all of them today, but just understand there are different ways to address this. And the main idea here is we use our existing assets, and that could be cash in the bank, that could be ongoing premium from cash flow, that could be old non-qualified annuities that we repurpose, it can be qualified money. This is the big one. From 401ks or IRAs, we can use cash value life insurance to fund these. But the idea here is from the first day of care, your asset creates the base policy. And it is what funds the initial period of long-term care. In the case of a life insurance policy, we create a policy and we actually spend through the death benefit tax-free while we're living to cover the initial period of care. And then when we exhaust the death benefit that we've created or the annuity benefit that we've spent through, then through a rider that exists on the policy, the rider can continue to pay for care for as long as you and your spouse live. These are incredible funding solutions, and they can come in the form of a single premium where we take an existing asset and we repurpose it, or they can come from cash flow where we set up recurring ongoing premium. But we're doing so into something that provides an asset that has actual value, not only cash value, but could be a tax-free death benefit. So either way, so an example here, we fund with savings. So I've got money sitting in a non-qualified, typically a bucket 2, what I refer to, type account. It's after tax. It's sitting in either a bank account, a brokerage account, something like that. And I have, in this example, we use $150,000 to repurpose. When I talk about repurposing, typically what we're doing here is we're looking at the overall portfolio of assets. And in any portfolio of assets that we're leading to retirement, there's typically your conservative portion, your moderate portion, and your more aggressive growth function. This is generally looking at the conservative part of your portfolio and carving out a portion of that, right? So we're not saying take all of your money and dump it into any one thing, but in the overall portfolio of how you're going to address retirement funding, of the conservative portion, we're going to carve out a piece of that and we're going to repurpose it specifically for this. So for an example, for a couple here at age 60, if I repurpose a $150,000 bucket 2 type savings asset, that becomes the premium. What do I create with that is a $91,000 annual long-term care benefit, and that's tax-free. That's a monthly benefit around $76.18, right? So that's close. That's, in Michigan, that's coming close to fully funding the care need. It goes a long way, but it also creates a tax-free death benefit. So in the world of long-term care planning, as I said, one of the financial worst case scenarios is to live a long time and pay a lot of premiums and die without a claim. The insurance company keeps it all. In this case, there is a death benefit, right? So if you were to take something like this and create it and then die soon without needing care, you get a massive return via a tax-free death benefit. But if you need the care, then a $7,000 monthly benefit would go until you've exhausted the death benefit portion of your money, and then you would go on to the insurance company's money pure. And they would take that $91,000 annual benefit, and this is a pool of money that's available for both spouses, and they would pay that out for a lifetime, meaning you can't outlive the risk. That is what I would call the creme de la creme of the long-term care strategies. If we can fund something that would reasonably finance most of the care risk for the lifetime of both spouses, you've hit it out of the park. And just to give you an idea, you would have to have about a 61% annual rate of return on that asset to provide that level of benefit. So again, going back to, can you self-insure this risk? Man, you really have to do amazing work in the investment world to keep up with what the insurance world can do for this. It's just simply using the right tool for the right job. $80,000, just to give you an idea of, maybe a little bit lesser funding. But again, we're creating a cash value and a tax-free death benefit with a monthly benefit to go. And in this case, we didn't include the rider. So in the previous case of $150,000, we took the $150,000 and we paid for the whole thing. We paid for the base policy, and you see here, we paid for the rider. One and done. This is a set it and forget it plan. Well, if we had the $80,000, we could do that, create the base policy, and then there would be an annual premium for the lifetime continuation rider. So this, you want to think about this as this, your money that you put in, the $80,000, look at that like the deductible. And if you understand insurance, the higher deductible that you have, the lower the premium, right? So in your car insurance, if you're willing to go from a $500 deductible up to a $1,000 deductible, you're rewarded by a drop in premium. Same thing here, same concept. And it's a powerful concept. You put your money out to cover the base policy. So 24 months, remember a male average stay is about 2.5 years. So you're covering most of the male risk. Female, 3.7, you're not covering all of it. So this becomes more important. But this rider premium is guaranteed, all right? So they're not going to raise that premium ever in contrast to the long-term care traditional insurance. So another idea, if you don't have the assets sitting there, maybe you've got the cash flow. So funding this policy with a $6,000 annual premium, and again, guaranteed, very different from the long-term care traditional insurance, that annual premium will get you about a $7,000 monthly benefit that pays for your benefits tax-free and also comes with a death benefit. And that includes the lifetime rider. So again, an annual premium or repurposing an existing asset. Both can get you there. You may find yourself from a cash flow perspective or an asset perspective, maybe you're not all in one place to be able to do it all. So depending on where you are in the timeline, there is a phased approach that you can use. It's called a stacking strategy, and it basically entails over periods of time, you build a portfolio of these types of asset-based benefits. So at age 40, maybe you can only afford an annual premium of $1,300. Then you add to that, and age 50 you add to that, and you stack these benefits so that by the time you hit retirement, you have a fully completed death benefit. You've got now solid long-term care benefits, and you fund it that way. The big winner in this, and for where I see most people, and a lot of people on the call, and I talk to a lot of you guys, the most common thing I see out there is I've got most of my money in my 401k. I've got a little bit of home equity, maybe a little bit in the bank, but most of the money is in the 401k or the IRA. You can actually repurpose a portion of these qualified dollars now. And again, those law changes allowed a lot of that to happen. But now you're able to take money that is initially tax-free, pay those taxes very efficiently, internal to the product that we're talking about here, and then pay for the benefits tax-free. So how do we get real efficient about this? We take an asset that has never seen Uncle Sam, 401k, IRA, take a portion of that and allocate it towards the long-term care strategy. Now that dollar gets repurposed over time, and those premium payments that I referred to in the funding, those happen internally. Those aren't something that you have to do specifically. This has all been patented and put together as a package deal by companies out there. And those distributions get taxed, not the whole amount, but the annual distributions that go between your asset and the long-term care funding, insurance end of it. And you pay taxes on those little portions, but the benefits that you create to pay for tax, to pay for care, or to pay for a death benefit, those come out tax-free. So one of the things I always say we need to do with taxes, we don't avoid them, we don't evade them, that's illegal, but we do minimize them. We do plan for them, and where possible, we recover them. That's the magic. And if you recover them, maybe it's recovered in the hands of your spouse, so they are made whole again. Or maybe you recover them in the hands of your children, so that your legacy is whole again. So looking into those opportunities is huge. So again, if I have a total portfolio of my conservative portion of that, we repurpose a piece of it. And there are incremental premium payments that flow between the care product that we're talking about here that happen internally, but you're getting a bonus by the carrier up front. So if you contribute $150,000, there's a bonus that is added by the insurance company, and this helps sweeten the deal to attract the consumer dollars, because that bonus takes a $150,000 asset, turns it into $187,000, and then we take these annual distributions internally that happen over the course of 10 years. So you get an annual 1099 for the $18,750, and then we create an amplified tax-free benefit for both long-term care and for death. So some examples of what this could look like, in a $150,000 qualified asset. And again, these numbers, please understand, these are for illustration. I don't want you to think that these are, spot on or hold me to the penny. This is to give you an idea of the level and magnitude of benefits. But if I take a $150,000 IRA and I point it into something like this, I get a bonus, I get approximately $188,000 of a long-term care focused asset now. That buys me a policy with a death benefit, in this case, of $166,000. So if I die, this death benefit comes back out tax-free. So I've already beat the curve on what I would have had to pay in the form of taxes, right? So if I die with a $150,000 IRA, what do my beneficiaries get? They get the 150 less taxes. Well, I took that asset and I turned it into a tax-free death benefit. So if I die early in retirement, I've already won. So there's 3 ways you can approach this. It's called quit, live, or die. If I quit, that means I walk away from the whole planning thing and I just take my asset and I go home. But if I live a long time and need care, that's option 2. And then mortality is option 3. That's still at 100%. I check every day. So either way, with a permanent asset, you're going to come out ahead in this example. So I buy a base policy that pays me almost $7,000 a month. And this is for each spouse. The real home run here is the case where husband, wife, maybe the husband or the wife, I don't care, one of the spouses has the large retirement account. Well, you can't generally cover a spouse under someone's IRA, right? So the IRA is individual. You can't use that in any type of tax efficient way for a spouse. In this scenario, you can. You can use one spouse's qualified plan to cover both spouses tax-free for long-term care. Powerful. It's the ultimate. And in this case, the way this policy is designed, we've baked in the rider. So this is a one and done. I take the 150 and I get my $6,934 for one or both spouses tax-free for life to cover care with a death benefit if I never needed care. All right. So this one is huge. And you would need about a 55% annual rate of return on an asset to keep up with generating enough income to pay those care expenses. It's just, as I like to say, you can't get there from here, right? So this is huge. If you have an existing annuity, I come across this a lot too. Maybe you picked up an annuity somewhere along the way and it's not specifically Pension Protection Act compliant. The IRS gives you the opportunity to do what's called a 1035 exchange. So there's no tax involved. We exchange the money of the old annuity into the new annuity that is Pension Protection Act compliant. And in this case, here's an example of a $200,000 annuity. Doesn't have any long-term care benefits. If we don't do anything, then you have to pull money out of that annuity, pay ordinary income, and then pay for care with what's left. So that's not desirable. What is desirable is I repurpose it, and of that annuity, I internally to this strategy, you don't have to do this math, 154 of it goes to the base plan, 45 of it goes to the rider, and this creates a monthly benefit of $4,651 that can be used tax-free for long-term care for the life of the insured. In this case, this is a female, age 71. So that annuity will always have some value in it. It's an asset. So if we don't need the care, we still have the asset itself. Here's an example of a repurposed annuity for a 63-year-old male. So again, $200,000. This can create $800 or $8,000 of monthly benefit. And in this case, the rider is 72 months, 6 years long. So I've got 2 years of coverage that I create with my money, the $200,000. And then the insurance company adds a rider for 6 more years. So I've got a total of 8 years, and I could potentially get $800,000 of tax-free long-term care benefits from a $200,000 asset. Again, it's just efficiency. It's using the right tool for the right job. Trying to fund this on your own or using traditional care insurance can be a very expensive route. These are the ways that this is being handled today. So if you're on this call, you got to consider your own, personal situation. If you've got additional money that isn't specifically guaranteed or set aside for retirement income, if you know you're going to be coming into an inheritance, if you came into an inheritance or a windfall and you're not sure what's the best use of the money, if you do have a desire to protect assets and pass them to the next generation, if you're considering a Roth conversion, right? So that's the idea behind the Roth conversion is, as we've probably figured out by now, taxes aren't going to be lower in retirement, and it keeps getting worse. So a lot of people are considering Roth conversions. We've covered Roth conversions on a couple calls. We've also covered life conversions, where instead of converting to a Roth IRA or converting to a Roth type of account, we're converting to the father of that account, the traditional life insurance type account. Senator Roth got the Roth code from the life insurance code, and all he did was put limits and restrictions on it. So if you're healthy, you may qualify for the better version, which is the life conversion. But if you're really concerned about care and protecting this risk that we've talked about and the effect it could have on your family, this is a big one. So, from where you guys sit today, we've at least opened your eyes, or we've at least exposed you to the risks, some of the things that could happen as a result of this, and some possible solutions that may be available to you to really help nail this thing down and get it right. They always say you're not ready to live truly until you're ready to die. And this planning is part of it. It's an unsettling thing for a retiree mid-retirement to discover that they never put a plan in for care, and they've gone beyond the window where their health allows them to qualify for these types of benefits. It's a sad thing. I talk to a lot of people that come to this too late in the party, and they don't anymore qualify for these types of benefits. And, it's a shame, but I think our industry does a pretty poor job of getting the word out and really helping people understand the risk and what they can do about it. So that's what we've tried to do today, or what I've tried to do today. And, I would tell you, I appreciate you guys. I know there's a million things you could be doing with your hour on Tuesday. I don't take it lightly that you spend it with me. And my hope is to continuously bring you guys information and strategies and solutions that help you to have a way more successful retirement than you would have had without me. So I thank you guys for taking the time today. And if I've inspired you to take any action, I would encourage you, reach out, book a slot with me, and let's talk about what your strategy looks like. And if you don't have a strategy, that's a great time to start talking about one. And there's no obligation to this stuff, right? I just want to add value and make sure that you're getting pointed in the right direction.
If that video shook you up, good. It's supposed to. The threat is real. Don't let long-term care be the blind spot that destroys your family's retirement plan. Hit that like button, subscribe to my channel, and let's talk about what you can do today to plan ahead before it's too late.